Right, so we see small and medium enterprises widely regarded as the backbone of Nigeria's economy, accounting for over 90% of business and contributing significantly to employment and GDP. Yet access to finance remains a persistent hurdle, limiting their potential from high interest rates and collateral requirements to limited financial literacy and weak institutional support. Well, join us now to unpack what to expect in the second half of this 2025, and credit to the private sector and the real sector. We have Dr. Jeku Zomene, the Group Executive at the Alternative Bank, joining me right here in the studio. It's great to have you, sir.
Thank you, Laji.
And I know, for you being in the financial services sector, when you see interest rate decisions, definitely I know you are interested, in that. And we had another hold yesterday by the U.S. Fed. Nigeria here, it's been a hold. But the difference is for Nigeria, it's high. It's high interest rates that we're dealing with at this point. And we're also talking about balancing, giving credits to where credit should go. Private sector, the real sector, help these businesses grow at this time. What are you seeing so far in Nigeria? Do you think we're seeing any improvement, when it comes to, some of these small businesses or the high-risk businesses getting credit?
I think there's been significant improvement. I mean, from a liquidity standpoint and credit provision standpoint. But one of the things, and this discussion often comes up, right? Why are we not providing sufficient credit to the private sector? Why are we not providing sufficient credit to the MSME space and SMEs, etc.? And my response is often this. When we talk about providing credit to this sector, we are looking at our traditional money deposit banks or even the microfinance institutions. But in every economy, there are several financial institutions that play several roles, right? You need to understand, the general populace needs to understand that commercial banks, for instance, are custodians of depositors' funds, right? So essentially, you take money from the surplus in the economy, right, and provide the financing to where there's deficit, and then for those that charge interest, that the interest they charge is the premium you take for on the risk you are taking. So it means that if you give me your money to keep, right, you are not not interested in me providing that money in a high-risk venture where you lose your deposit, correct?
So, well, yeah. So I don't want to lose my money.
You don't want to lose your money. And in fact, the regulator will not want the bank to lose that money, which is why banks have capital. The capital a bank has is not money the bank lends, no. It's the buffer it keeps for the risk it's taking. So that if he loses your money, right, he can absorb that loss, right? Which is why anytime the regulator is looking at the bank's capital, they say, okay, your capital vis-a-vis the risk you are taking is insufficient, so you need to raise capital. Why am I giving this background? So it means that, to enhance the complexion of risk that financial institutions take, there are certain type of institutions that come to, improve that risk, and then before banks can come in and play, which is where you have institutions like development finance institutions playing a role. In Nigeria, we have several. I think we have about 8. We have the BOI, we have a BOA, there's Bank of Industries, Bank of Agriculture, we have Development Bank of Nigeria, we have Nexim, etc., etc. Those institutions are mandated in all jurisdictions have similar institutions, are mandated to come into that space to help improve, provide the nature of capital that's required to support the entrepreneurs, and then the banks are coming to support, okay? So has lending improved? Yes, lending has improved, but can it get better? It needs to get much better like day before yesterday.
Because some would argue that, the banks make a lot of money in Nigeria. I've had a conversation recently. She said that she runs a bank in the UK, and she doesn't get the amount of charges she gets from a Nigerian bank. So people believe the Nigerian banks make a lot of money, so they should be able to play around with some, some credit.
In a way, that's like the 6 blind men of Hindustan who went to see an elephant. So they're seeing one part of the elephant.
Right.
But if you consider that in Nigeria, right, first of all, when a bank is lending you money, right, in the sector we have what we call the cash reserve requirement. And today the cash reserve requirement is at 50%. right? 50% is one of the highest, probably the second highest globally. What a 50% cash reserve requirement means essentially is that for all the deposits the bank has, remember I started by saying the bank doesn't lend its capital, right? So it's the deposits that the bank lends. For all the deposits the bank has, the central bank sterilizes 50% of it and the bank doesn't have access to it. So that money is not available to lend. Now, why will a central bank do that? Why will a Federal Reserve Bank do that? You do that often when you are targeting inflation and when you are targeting exchange rates, right? So what that does is that when you put money into the system, for instance, when the government releases FAC, and you know it's a significant amount of money, you try to mop up a lot of that liquidity, right? So that it's not available to, you know, when you say too much money chasing the hair.
Few goods.
So you mop it up, so it's not available. Now, what that does for the bank is that it significantly increases its cost of doing business. Because some of those deposits, I'm taking it from somebody at a cost, right? And I'm keeping it, and it's unremunerated. So you have different kinds of cash reserve requirements globally. There's a remunerated cash reserve requirement. There's unremunerated cash reserve requirement. There's unremunerated, there's differentiated dynamic cash reserve requirement, and there's unremunerated differentiated dynamic cash reserve requirement. So let me explain.
Huge requirements.
So when I started my banking career in 1998, 1999, the cash reserve requirement was 1%.
1%?
Yeah. I think you moved to 2%.
So if I was depositing money in your bank,
yes,
you just give the CBN 1% of it?
Absolutely. I think you even moved to 2% during the Soludo consolidation era, right? And because banks raised capital, and I think there must have been some concern around the level of liquidity in the system, and so it was increased to 2%. But subsequently, over time, when the regulators started using monetary policy instruments to target inflation and exchange rate stability, it now became this, mopping up this liquidity that banks have. So now, cash reserve requirement cost is just one cost that the Nigerian bank has. In Nigeria, the bank has what we call the AMCON resolution cost, which is a percentage of their assets. We also have, there's another cost that was just recently introduced. It can't come to mind now. But there are several layers of cost, and I suspect in terms of cost that the banks bear, and I'm not saying this
aside from EMTL and all of that.
And I'm not saying this because I work in the industry, right? So I'm saying this almost from an academic standpoint. Those costs, somebody is going to ultimately bear the cost. So while we appreciate what the regulator needs to do, and it's important because if not, we'll have had runaway inflation and exchange rate crisis, but that cost will ultimately be passed on to the borrower, and which is why you have these high interest rates, right? So when you then say the banks are making a lot of money, right, from a returns perspective, the banks are carrying a lot of cost. Even the cost of raising capital, if you have raised capital, a few years ago when I was in the space of capital raising, investors will require an ROE of, say, 17% from their investments in a bank in South Africa, for instance. In Nigeria, it was over 30%. I don't know what it is today. So when you go take investors' money and invest in your bank, you have got to pay the stakeholder his money back now.
So there's a cost at this point. The banks are not suing the money.
When we say the banks are suing the money, I see those numbers. They look interesting. But once you adjust for all these things, you see that relatively they are not making that much money.
All right. So there's this conversation now a lot about faith-based lending, faith-based investments, at this point, and we have a couple of faith-based banks at this point. How is that helping, this situation? Because obviously you're not allowed to charge interest rates. That's as a faith-based platform. Mm-hmm. So how is that growing? How's that helping, credits to the private sector?
Okay, so let me put it this way. I'd taken an early retirement from banking at some point. I just wanted to face my role in the academia and some non-executive roles I had. And then I was invited to join a faith-based bank. And in the course of the conversation, one of the things that had often bothered me while I was actively, doing all the investment bank, commercial bank stuff was, in Nigeria, when you engage your customers, they will often tell you, banks don't want to take risks with me, right? They just want to give me money, and then when there's a problem, they'll run away. And then when I encountered non-interest banking, and specifically Islamic finance, and because I currently am a group executive with Alternative Bank, which is a non-interest bank, and I was having a conversation with my friend Abubakar Suleiman, who is the MD of Sterling Bank. And midway into the conversation, I said, I know exactly what you are trying to achieve, right? Because when I left commercial banking, I wanted to focus on impact investments. I wanted to see where, when I make an investment, it changes the lives of people, it creates value in the society and the larger community. And I said, this is impact investment. Essentially, what, when you say faith-based bank don't charge interest, that's not exactly what it is.
It's not a true picture.
No, I mean, on the face of it, that's what it is.
Right.
So in Islamic jurisprudence, there's something that's the fiqh versus the masakid, which is the law versus the higher objective of the law, right? The reason why Islamic finance institutions don't charge interest, because in Sharia jurisprudence, it's perceived as exploitative. You are exploiting the customer, right? So it's not because it's interest in itself. So everything that's exploitative is haram. Just the same when in Islam, alcohol is haram. It's not haram because it's alcohol. If you look at the masakid, it's haram because it intoxicates. So anything that intoxicates is haram. So it means that heroin will be haram, drugs will be haram, etc., etc.
You can't invest in any of that.
You can't invest in any of that. Now, so when you then map Islamic finance against the market and how it's going to impact on the market, I refer to it as a superhero license, right? It's a superhero license in the sense that because Islamic finance has, or non-interest banking has, two broad product groups. There's the trading side and the equity-based side.
Right.
Right.
Well, let me just pause you there. I'm so sorry. I just need to take this quick break. But this conversation is getting really interesting. I know you're heading. When we come back, we'll continue the conversation. That's at the moment. Just stay with us. Welcome back. Well, let's head back to the conversation. And I still have with me Dr. Jeku Ozemenez, a group executive, the Alternative Bank. And we're talking about non-interest finance and credit to the private sector. Thank you so much for staying on, Doctor. And there you were.
Radically change the face of banking, not just in Nigeria, but how it impacts the market and our customers.
Right.
Now, remember earlier I said that there are traditional, conventional banks are not structured to take the kind of risk that some of these SMEs require. But you see, in the non-interest banking space, we have equity-like products where the bank can actually partner with the customer in an investment. So they're investment-type products. So for instance, I have a product where I'll provide financing. If I review your project, I provide financing to you. You act as my agent, and I pay you a commission, right? We have products where, and I'm very particular. I want to explain the product in brass tacks. I don't want to use highfalutin terms that will confuse our audience.
Right.
We have products where we essentially share profits, right? And this is on the equity side. We have lease-type products. Now, on the trading side, when people say, oh, we don't charge interest, and we say, okay, we have a product like our Murabaha product, which is cost plus markup. People, they say, no, but if you're doing markup, that markup is interest, right?
Right.
But it's not. It's radically different, and I'll explain why it's radically different. First of all, remember that it's based on ethics. Non-interest banking is based on ethics. So first of all, the idea is that you are not exploiting the customer. That's one. Second is that when we look at the business and we agree on a markup, that markup is fixed for the entirety of the tenure of that transaction. So it's not like an interest-based relationship where midway MPR changes or something. I'll say, okay, you know what, I need to change my interest rate. No. And even when the contract elapses, I cannot charge you anything above the markup, which is the profit we have agreed that we're going to share, right? What does that do for the customer or the borrower, or the not borrower in this sense, or the partner? It enables the person to plan appropriately because you know the horizon of the profit that's going to be available to be paid to the bank and what you can take. Now, the equity type investments are even much more interesting.
But does this happen with small businesses? Are small businesses able to come to say an alternative bank now and say, okay, I need to do this business. You're going to share profit with me. Is that how it works?
We're not even structured yet. We have not even gotten to the side to play with the big boys because from a capacity standpoint,
right, we
don't even have the capacity to play with the big boys. So this is a growing market. So it's available to every customer, provided, remember that the credit principle still applies.
Right.
The 5 C's of credit. The first C is character. You must show character. In fact, in Islamic finance, the person has to be trustworthy. Remember, this is based on ethics. So we have to review that and ensure that this aligns with this individual. My colleague will say that we should add a 6th C to the 5 C's of credit,
right,
which is consistency. Looking at this individual, you have proven over time that you are consistent, right? You have taken financing from people, you have not failed, you have done things with people, you have been upright, etc., etc. And then it makes it easier because remember, banks do not lend against collateral. Banks are not real estate firms. Collateral is just the comfort they take in case the risk crystallizes. So principally, we are lending against character. Every other thing flows, which is why today, within that consistency, some of us argue that at some point, data will replace collateral.
Data?
Yes, because with data, you have all the information you need to determine whether somebody is consistent or not.
And does that dovetail into open banking? Because there's also conversations around open banking.
It dovetails into open banking. It dovetails into everything you do, whether in the retail space, everything you do. Once you have the data, that gives us an idea of what your habits are, how you behave when it comes to your relationship in business. Then I can literally...
Do you think Nigeria is ready for open banking?
You see, the thing about change is that if you are still dilly-dallying, one day, if you are treading water, you're actually retrogressing. A few years ago in this industry, we had some small banks. We used to call them new generation banks, and people used to refer to them as one-branch banks, right? We had these big behemoth banks where, like, who are these fellows? They will soon fizzle out. A few of them fizzled out, but those that survived are the big banks today. Some of those behemoths that we were talking about back in the day have simply disappeared. So I think open banking is here to stay. With digitalization, open banking is just a matter of time before it happens.
And, definitely talking about change at this point, there's also a lot of conversations around stable coins, blockchain technology, and we're hearing, some banks or like JP Morgan now actually looking into, that side of things. Is Nigerian banks actually exploring, such technology at this time, or are we just saying, you know what, we don't understand it, let's just stay away for now?
Okay, a few years ago, this conversation was a bit esoteric, and everybody was cautious about digital currency, etc. In fact, some people even put digital. I never truly believed in digital currency as it was then being marketed. But I think everything changed for the world with, what's the name of this, Libra, the Facebook currency.
Facebook, right, Libra.
As soon as Facebook launched Libra, all the regulators across the world woke up. I'm not sure people understood the implication of that Facebook's move. When you have a digital currency and you have a platform like Facebook that cuts across jurisdictions, right? you know, one of the things that a government uses to affect fiscal policy is its monetary policy, right? If you have some young chap sitting somewhere, right, who can control your monetary policy from anywhere, right? It means that substance over form, you have a new global president, right? Because if I can control your monetary policy, I can actually overthrow your government. I can change market dynamics in your country. I can do anything. And I think that it was a wake-up call for the doubters. And so you then began to see even central banks, sovereigns begin to look at central bank, digital currency, et cetera, et cetera. So that will happen. If that will happen because the world has been shocked into the reality of what can possibly happen if you don't do something, you don't move before them. I know that blockchain technology is going to play a significant role in everything we do. Maybe not as it was initially touted, because when it first came out, it was like
against all the central figures,
yes,
decentralization,
yes,
and all of that.
It's going to. The technology is there, and because technology is changing. So, I mean, Moore's law says that the level of change in technology is going to be moving, not even in geometric progression, in, I don't know, exponentially. So it's going to be improving over time, and we're going to see this that has come to stay.
I'm talking about improvement and big changes happening at this time. Who knows? Maybe AI might be a central bank at some point with the way things are going, artificial intelligence everywhere. But who knows? We'll keep watching.
I'm waiting for intelligence augmentation, because I'm tired of having to read things. I want to be able to upload it and have this conversation with you.
Natural
and you think I'm an Einstein.
Yes, exactly. Just put in the AI, install it. Thank you so much. It was great having this conversation with you, Dr. Jeku Zemene is a group executive at the Alternative Bank. Thank you for coming on today.
Thank you.